Chapter 15, Monetary Policy, just so we know where we're going and where we've just come from. I'll assume at this point you watched the Chapter 13 video, the Chapter 13 PowerPoint, and the Chapter 14 PowerPoint. If you have, we've already covered much of monetary policy. We've already covered much of Chapter 15. The reality is that how our money supply works and how the Fed controls the money supply and tries to control the economy, while when you first learn it, and for many of you I assume that is through this course, the first time you read it, the first time you hear me talk about it, it seems very confusing. The reality is that once it clicks, once you understand it, once you've heard it 4 or 5 times, it's relatively simple. And that's why the chapters start to get repetitive. And that's very much intentional on the part of the textbook. They want you to read through these things 3, 4, 5 times so that it clicks. And so they kind of talk about the same things with different names: money and banking, monetary policy, the Fed. It's all so intertwined, and you're going to see that as we go through Chapter 15 here, that it's all very much connected and will seem like a repeat of the previous chapters in many ways. The money market. Money is like any other commodity. It is traded in the marketplace. There's a money supply, which we've talked about is controlled by the Fed, and money demand by the people. They determine the price of money, which is the interest rate. At high interest rates, money is expensive to acquire. At low interest rates, money is cheap to acquire. So as the interest rates are higher, if the Fed sets their rate higher to the banks, it drives all the other interest rates higher. Money is more expensive to acquire, so the money supply will stay close to where it is. It won't expand as quickly. People won't have as much money to spend. Aggregate demand will not increase rapidly, and the economy will stay stable, grow slightly, or even decrease. At low interest rates, money's cheap. We have a higher demand for money to buy cars and homes, and businesses will be more likely to borrow money to try new things and be innovative at low interest rates, which will put more money in the system, create more spending, create more aggregate demand, and move the economy forward. Of course, we've had low interest rates for a very long time now, and one of the things we've learned is that low interest rates, if kept low for too long, as they were in the late 90s and early 2000s, make money too cheap, and it creates bubbles. And bubbles burst and cause recessions. We had the housing bubble burst, and it caused a recession. Triggered a recession is a better term. And so money, once again, cheap to pull us out of that recession, and will most likely create another bubble. If people hold cash as M1, they suffer an opportunity cost, the foregone interest they could have earned. So if you, for every dollar of cash you have, you are giving up the amount of interest you could be earning if you had that in an investment, in a bank, in bonds, in a savings account, in a stock. That's the opportunity cost of having that cash. The quantities of money people are willing and able to hold at alternative interest rates. That's the money demand. At low interest rates, the opportunity cost of holding money is low, so people will hold more of it, and vice versa. Right now, interest rates are so low, bond rates are so low, that a lot of people are holding a lot of cash, because the trouble of going down to the bank and investing and worrying about all of that to earn, 75, 80 cents on $100 over the course of a year, because it's many places it's less than 1% right now for bonds and other investments or savings accounts. It's hardly worth it. So people are holding on to their money right now. If you go back to the early 80s, when interest rates are 15, 16%, people wouldn't have cash in their pockets because it made no sense to hold money. If you held $100, it was only worth 85 at the end of that year, so it made no sense to hold it $100. You might as well have it in there earning that high interest so you don't lose money to inflation. Why would people want to hold money? That is, have a demand for money. First, transaction demand. People need to hold money just to buy to buy things, to have cash, to make purchases. The transaction demand has gone down recently with debit cards and credit cards being taken everywhere. I know I personally carry very little cash and will go through very little cash over the course of a year because I buy everything on a credit card. And most credit cards now have packages where you can either earn airline miles or get cash back. 1% is the typical rate. So if I buy everything if I were to spend, I'll throw out round numbers, not that this is close to what I would spend, but if I spent $50,000 a year and put it on a credit card, at the end of the year, I get 1% back, so I get $500 back. And so if I pay my balance at the end of every month. Now, if I were to pay everything in cash at the end of the year, I would have spent $50,000 in cash and I would not have that $500. So at this point, it actually makes more sense to purchase things that way if you make the payment every month. And the other thing is, I only pay as I need it. So my money in the bank that has not been sent to the credit card company yet is earning interest. So if it's earning 1% interest, over the course of the year, after you do the math, you're looking at about $750 between the cash back and the interest as you go. Because of course I wouldn't earn interest for the whole year on money I spend early. So I'd be $750 ahead at the end of the year compared to paying with cash. So because of that, transactions demand is decreasing rapidly. More and more people are moving to these models of not holding actual dollar bills. Precautionary demand. People also hold money for unexpected market transactions or for emergencies. Most people have cash on hand just for an emergency. I mean, what if all the banking system computers went down? We'd have to make transactions with cash rather than, we couldn't use credit cards or debit cards or anything else. So people are worried about that. It hasn't really ever happened for more than a few minutes at a time, but people are still worried about it. The next is speculative demand. Some people also hold money to be able to take advantage of an investment opportunity in the near future. This is holding money in cash, maybe in a savings account, more so than in actual dollar bills. But just in case you think there might be a good investment out there, you want to have some money set aside, most people actually will do that in a bank and earn the savings rate, which right now most banks is about, what, 1/4%, I think. So it might as well be cash. It's just you don't actually physically have to have the dollar bills and have the risk of having the dollar bills and getting it stolen and all those other things. Changing interest rates. The Fed controls the money supply, as we've talked about. By using the Fed policy tools, it can alter the equilibrium of interest rates. By increasing the money supply, causing a surplus, the Fed lowers the rate of interest. By decreasing the money supply, the interest rates will go up, as we've talked before. Interest rates and spending. Lowering interest rates is a tactic of monetary stimulus, and the purpose of which is to increase aggregate demand. Already talked about that, so we'll move on. Raising interest rates is a tactic of monetary restraint, the purpose of which is to decrease aggregate demand. So once again, we have talked about that previously and how all that works. Policy constraints, short versus long-term rates. The Fed has greater influence on short-term rates, that is the Fed funds rate, than long-term rates. So the Fed has very little control over the actual mortgage rates. The banks determine the mortgage rates, but they're based on the Fed funds rate, which we talked about earlier, is the rate that the bank borrows the money from the Fed. So if the bank borrows the money from the Fed at 5%, they're going to charge, we talked about 3.5% more than that. But the Fed doesn't actually set that rate. So banks could all decide, you know what, instead of 3.5% markup, we're going to charge a 10% markup. The Fed has no control over the banks wanting to do that. The banks don't do that because competition dictates that the cheapest loan will get the most customers, and so they all drop that rate pretty much as low as they can. which is about that 3.5%. The Fed's monetary stimulus will be most effective as long-term interest rate changes mirror short-term interest rate changes. So what they need to do here, this is just getting into a little bit of idiosyncratic finance stuff, but ideally you want short and long-term interest rate changes to be the same. So if long-term interest rates, the 30-year fixed were to go up, you'd also want the short-term to go up. If there's a disparity there, that could create problems. Reluctant lenders. We talked about this in both the chapter 13 and 14 PowerPoints about how banks right now are not lending out all the money that they can. So the banks have to be willing. This is a constraint over what policy-wise, what we can do. If the banks aren't going to lend out the money, that is a limitation on what policy can do. Liquidity trap. This is kind of what's happening right now. When interest rates are so low, the opportunity cost of holding on to money is low, which we talked about a few slides ago. So people, by holding on to a wad of $100 bills in your mattress, it's not hurting you that much because, once again, because interest rates are so low, inflation is so low, price changes aren't really occurring right now, with the exception of a few items, that if you had your money in the bank or in a bond or something, you're not making enough to make it worth the trouble. And that's the liquidity trap. Low expectations. Investment decisions are influenced by expectations. So if you believe something's going to happen and you want to invest, you do that. But if you don't have confidence in the investment tools that are out there, then you're going to hold on to your money. And so that would keep aggregate demand from increasing. You're not going to, but right now that is starting to change because in the middle of 2013, we're in the middle of a pretty big stock market boom. And so as expectations are increasing in the stock market, people are putting more and more of their money in the stock market, which is starting to drive aggregate demand and helping the economy. Time lags. It takes time for the economy to react to changes. The stock market will react very quickly, sometimes within minutes, and we talked about that previously. But before the market as a whole, because not everybody's involved in the stock market, before the market as a whole reacts, like the book here says, it can take 6 to 12 months before we respond to monetary policy. The monetarist perspective. The Keynesian view of monetary policy says that changes in the money supply affect macro outcomes primarily through changes in interest rates. So the way that the Keynesians believe that the way that you control the economy is primarily through interest rates. The monetarist view, those who believe that the money supply really controls the economy, believe that only the price level is affected by the Fed policy, and then only by changes in the money supply. They say monetary policy is not effective for fighting recession, but is a powerful tool for managing inflation. So the monetarists believe that the amount of money in circulation is really going to control prices. So having more money being created is going to drive prices up, and having money taken out of the system is going to drive prices down. But it won't actually fight the recession. Won't actually increase aggregate demand. That money will simply go into higher prices. Where the Keynesians believe more money in the system will create more aggregate demand and will not necessarily increase prices. The equation of exchange. The equation of exchange is NV equals PQ. Now, normally I don't focus very much on the equations that we go through in these PowerPoints, but this one I'm going to because it's important and I want everyone to understand it. M is the money supply, and V is the velocity in circulation. V is the number of times each dollar is spent. So let's just focus on that. M is the money supply. We know from previous slides that the money supply is total money supply is about $10 trillion. And so what we need to know is how many times is each dollar spent per year. Well, we know that the GDP is about $15 trillion. So what times 10 trillion equals 15 trillion? 1.5. So velocity of money, each dollar that is in existence is spent about 1.5 times per year. So 10 trillion times 1.5 equals $15 trillion. So that's the left-hand side. The right-hand side, PQ. P is the average price of goods, and Q is the quantity of goods sold. So if MV equals the GDP, 15 trillion, PQ also equals the GDP. And the gross domestic product, remember, is the sum of all transactions. So another way of saying the sum of all transactions is the average price in every transaction times the amount of transactions. So PQ is also going to be about 15 trillion. So both sides of this equation equal the GDP. And yeah, so that's really what this equation tells us. And this is a pretty famous equation, the equation of exchange. They continue on with the equation of exchange. The quantity of money in circulation and the velocity with it exchanged hands will always be equal to the GDP. And the monetarist view is that if M increases, P or Q must rise or V must fall. So this equation is very much from a monetarist perspective. So if you increase the money supply, you're either going to have the amount of times each dollar is spent must fall, or P or Q must rise, thereby increasing GDP. If we assume V is stable, that is, if the number of times each dollar spent does not change, V is a function of how people handle their money and the institutions they use to do so. Neither should change much in the short run. So people aren't going to change their spending patterns much in the short run, how much they spend their money. So V is actually a very stable number. Thus, the total spending PQ must rise if money supply grows, and the velocity is stable regardless of interest rates. So once again, this is the monetarist perspective, that interest rates don't control the GDP. That, once again, from the monetarist point of view, not the Keynesian point of view, but from the monetarist point of view, that total spending must rise if the money supply grows, and V is the same. Money supply focus. If spending increases when the money supply grows, then the Fed should focus on the money supply, not interest rates. Fed policy should not be to manipulate interest rates. Fed policy should focus on the size and growth of the money supply. Once again, this is the monetarist perspective. The Keynesian perspective is exactly the opposite. Well, I shouldn't say that. The Keynesians want to grow the money supply as well, but they also want to manipulate interest rates. Monetarists, how they fight inflation. The policy goal is to reduce aggregate demand. That's how you want to fight inflation, is to reduce AD. Keynesians want to shrink the money supply and drive up interest rates. Monetarists, interest rates are likely to be high already. A decrease in the money supply will lower nominal interest rates, not raise them. So this is a little different perspective. Interest rates are likely to be high already. A decrease in the money supply will lower interest rate, not raise them. What this means is that remember, the nominal interest rate is the interest rate we actually see and pay. The real interest rate is the nominal interest rate minus the anticipated inflation rate. As the money supply shrinks, the price level falls, and the anticipated inflation decreases, so nominal interest rates will fall, not rise. Once again, try and say this a different way. As the money supply shrinks in trying to fight inflation, price levels will fall. And the anticipated inflation, the amount that is built into interest rates to make the inflation, to make the real interest rate rather than the nominal interest rate. So that built-in amount will decrease. So that will actually drive down nominal interest rates. So again, that's the monetarist point of view. To close any inflationary GDP gap using monetary policy, you reduce the money supply. Keynesians Interest rates rise, which causes a reduction in spending. Monetarists believe that once people are convinced the Fed is reducing the money supply, anticipated inflation falls and the nominal interest rate will also fall. It doesn't need to be forced to fall. It just will fall, and short-term interest rates will rise in response to the Fed action, but long-term interest rates will react more slowly. So once again, the Keynesians see, when you're trying to fight inflation and reduce the money supply, they see interest rates rising, where the monetarists see interest rates actually falling. Monetarists advise steady and predictable change in the money supply to reduce uncertainty and thus stabilize both long-term interest rates and GDP growth. Just to take a step back here and talk about why the monetarist Keynesian thing, and the monetarist seems a little more complicated, and to be honest, the monetarist point of view is a little bit more complicated. Basically, the monetarists they're a little bit more of a laissez-faire approach. They want the government to step back a little bit from intervening in the economy, increase the money supply slightly every year, and let the interest rates go where they may. Let the market dictate the interest rate is the typical monetarist point of view, where the Keynesians want absolute control and manipulation over everything. Now, in the past, you could point to what we talked about earlier in the slideshow about Paul Volcker raising the interest rates to fight inflation in the early 80s. Say, well, there's an example of a Keynesian approach working. True. Once again, we don't know if the monetarist approach would have worked to simply just reduce the money supply. We don't know since it wasn't tried. The other thing is it was a Keynesian response to raise the interest rates to a Keynesian created problem. That by keeping interest rates falsely low and by creating the money supply too quickly, they created an inflationary situation. The Keynesian policy created an inflationary situation that a Keynesian response then fixed. Where if the monetarist policy had been followed all along, the belief, and once again we don't know, but the belief is that interest rates, if they were not held falsely low, and the money supply was increased more reasonably, that you never would have had that inflationary situation in the first place that would have needed fixing. Fighting unemployment. Policy goals to increase aggregate demand. So the Keynesians expand the money supply and drive down interest rates to fight unemployment. That's what we're doing right now. Monetarists, increased money supply leads to higher prices, immediately raising people's inflationary expectations. Long-term interest rates might actually rise, defeating the purpose of monetary stimulus. Monetarists conclude that expansionary monetary policy can't lead us out of recession. This is interesting because we're in the middle of a test run with this. The Keynesians, which is the approach we're taking to get us out of the 2008-2009 recession that we're still working our way out of, in order to bring unemployment down, you need to increase aggregate demand, and that would be to expand the money supply, which we're doing, and lower interest rates, which we're doing. But remember from our unemployment discussion earlier that while our unemployment rate is ticking down, most of those people, it's not as if people are going back to work. They're simply dropping out of the workforce. So in fact, the Keynesian approach has really not helped unemployment. If we had tried the monetarist point of view, which would have basically been to let interest rates fall where they may. They obviously would have come down as demand dropped for money after the recession. That expansionary monetary policy, because of the inflation it creates and the inflation that it could eventually hurt the economy, thereby making it harder to lower unemployment, the monetarists believe that both aspects of the Keynesian approach won't work for bringing us out of recession. And to be honest, they seem to have a point, because this has gone on a very long time. We're coming up on 5 years now, and we're still going through, in the middle of 2013, going through some pretty substantial problems. So the Keynesian approach, if it does eventually work, it definitely did not work quickly. and it looks like the monetarists have a very strong point on this one.